When people talk about money today, the conversation almost always follows the same script. Boomers are blamed for holding too much wealth. Millennials are described as crushed by student debt and rising costs. Gen Z is portrayed as anxious about a future they cannot afford. But almost nobody talks about the generation sitting quietly in the middle, and that silence is exactly what makes them fascinating. Generation X, born between 1965 and 1980, has quietly become one of the most financially successful generations in modern history. They are now in their peak earning and investing years, yet they rarely appear in headlines or social media debates about money. According to Federal Reserve data, the median Gen X household has a net worth of roughly $243,000. That is nearly 4 times higher than millennials and almost 8 times higher than Gen Z. And this did not happen because they were lucky. Gen X did not grow up in a smooth or forgiving economy. They lived through the dot-com crash, the 2008 financial crisis, multiple recessions, and the economic shock of the pandemic. Their careers were shaped by layoffs, corporate restructuring, and constant uncertainty. There were no investing apps, no YouTube gurus, no daily notifications telling them what to buy or sell. If anything, the system gave them more reasons to fail than to succeed. What separates Gen X is not income or opportunity, it is behavior. They developed a deep skepticism toward hype, institutions, and financial narratives that promised easy wins. They questioned advice instead of blindly following it. They avoided herd behavior when everyone else rushed in the same direction. And most importantly, they built wealth quietly, without needing attention or validation. Unlike generations raised on social media, Gen X never turned money into a performance. Their success did not depend on looking rich. It depended on staying resilient, independent, and patient. By staying invisible, they avoided lifestyle inflation, social comparison, and the pressure to keep up appearances. That invisibility became a strategic advantage. While others were chasing trends, Gen X focused on consistency. Their story proves a powerful truth. Building wealth is not about viral strategies or perfect timing. It is about repeating smart behaviors for decades, even when nobody is watching. And that lesson matters more today than ever. If this perspective already feels different from what you usually hear about money, comment number 1 below so you can watch the entire video and see how this mindset actually works in real life. That quiet, invisible approach to money did not happen by accident. It was built on something even more important than discipline: knowledge, and not the kind of surface-level knowledge that comes from headlines or quick tips, but deep understanding earned over time. One of the most defining traits of Generation X is their commitment to self-education over outsourcing their financial thinking. Research from Vanguard shows that Gen X is the least likely generation to use financial advisors. At first glance, that might sound risky or stubborn, but in reality, it reflects confidence built through years of learning. Gen X does not reject help because they distrust experts. They reject blind dependence because they believe understanding money personally leads to better decisions. They came of age at a rare moment in history. Information was becoming accessible, but it was not yet overwhelming. If you wanted to learn about investing in the 1990s, you could not scroll endlessly or chase trends. You had to slow down. You went to libraries. You read books cover to cover. You studied magazines. You joined early online forums where people shared experiences instead of selling shortcuts. Learning money was deliberate and often boring, which is exactly why it worked. Because of this, Gen X built foundational knowledge instead of superficial familiarity. They understood what they owned, how it worked, and why it fit their goals. Data shows their self-managed portfolios produced returns comparable to professionally managed accounts, but with much lower fees. More importantly, that understanding reduced emotional decision-making. When markets fell, they did not panic because they knew what they were holding. When trends exploded, they did not chase them because they could see the risk beneath the excitement. Their education did not stop at investing. They learned how taxes actually work. They understood credit, insurance, and debt structures. They paid attention to the boring details that quietly protect wealth. By refusing to outsource understanding, they kept control. Over time, this knowledge compounded just like their investments. It allowed them to make calm, consistent decisions for decades. And that is the real advantage. Financial literacy is not about complexity. It is about clarity, ownership, and the confidence to stay steady when everyone else reacts. That deep understanding did more than help Gen X make smart decisions in calm markets. It completely changed how they behaved when everything fell apart. Generation X did not learn about risk from textbooks or simulations. They learned it the hard way. Their first real lesson came during the dot-com bubble at the end of the 1990s. Many of them invested in technology companies that had exciting stories, but no real profits. When the bubble burst, the losses were painful. But instead of walking away from investing altogether, Gen X did something most people do not. They analyzed their mistakes. They asked why certain companies collapsed while others survived. They learned to separate real businesses from speculation and hype. That experience rewired how they viewed money. It created a natural skepticism toward easy money narratives and popular enthusiasm. They learned that when everyone is excited, risk is usually rising, not falling. Those were not abstract lessons. They were expensive lessons. And because they paid for them early, they carried that knowledge forward. So when the financial crisis of 2008 hit, Gen X was not encountering fear for the first time. Fidelity data shows they had the lowest panic selling rates of any generation during that collapse. While others sold at the bottom or froze in confusion, Gen X largely stayed put. Some continued investing. Others simply held on, not because they were fearless, but because they understood market cycles. They knew volatility was temporary. They knew ownership was long-term. This discipline was not about willpower. It was about comprehension. When you understand what you own and why you own it, price drops feel very different. They become part of the process instead of a signal to escape. Every crisis reinforced that understanding instead of destroying it. Over time, this pattern created something rare: emotional insulation. Fear did not disappear, but it lost its control. By living through multiple crashes and recoveries, Gen X internalized a powerful truth: markets fall, markets recover. Patience outperforms prediction. Their wealth was not built by avoiding losses completely. It was built by refusing to let losses change their strategy. And that mindset is one of the hardest advantages to copy. That emotional discipline did not stop with investing. Gen X applied the same thinking to something even more personal: their income, their careers, their entire financial lives. While most people think of diversification only in terms of stocks and bonds, Generation X quietly expanded that idea to everything that produced money. They did not want their financial future resting on a single employer, a single paycheck, or a single economic outcome. Instead, they built layered income structures designed to reduce fragility. Census data shows Gen X is more likely than other generations to earn income from more than one source. But the reason matters more than the statistic. This was never about chasing entrepreneurial identity or following passion narratives. Gen X did not call it a side hustle. They did not brand themselves. They did not post about the grind. Their motivation was redundancy. One stable job provided consistent income, health benefits, and retirement contributions. Additional income streams created options. Consulting work, small businesses, freelance projects, or rental properties were not meant to replace the main job. They were insurance. Together, these income streams formed a system that could bend without breaking. When one source slowed or disappeared, the household did not collapse. Bills still got paid. Long-term plans stayed intact. That stability reduced desperation, which is one of the most underrated advantages in financial decision-making. When you are not desperate, you can be patient, and patience is what allows smart decisions during chaos. This structure became especially powerful during recessions. After the 2008 crisis, fear dominated the economy. Jobs were uncertain, markets were volatile, Many households dependent on a single paycheck were forced to sell assets or stop investing at the worst possible time. Gen X, with diversified cash flow, had more room to breathe. Some continued investing. Others took advantage of undervalued assets, not because they were reckless, but because their income portfolio gave them margin. This reframed how they thought about money. Income was not just something to maximize, it was something to stabilize. Survival came first, growth came second. That order matters. A fragile system collapses under pressure, no matter how high the income looks on paper. A resilient system compounds quietly over time. This mindset allowed Gen X to withstand economic shocks that devastated others with higher salaries but weaker foundations. For them, financial security was not about earning the most. It was about reducing vulnerability, so no single event could erase decades of progress. That focus on reducing vulnerability shaped not only how Gen X earned money, but also how they spent it. And this is where their strategy becomes almost invisible. Generation X has a fundamentally different relationship with consumption than generations shaped by social media. They practice what can best be described as stealth wealth. They have money, but they do not advertise it. Pew Research shows Gen X is the least likely generation to share financial achievements online, not because they are private or modest, but because they understand the cost of visibility. When wealth is visible, it creates pressure. Expectations rise, comparisons begin, spending becomes reactive instead of intentional. Gen X avoided that trap by refusing to turn money into a signal of status. They did not feel compelled to upgrade their lifestyle to match peers, coworkers, or online standards. That freedom allowed them to make rational decisions instead of emotional ones. This is why you often see Gen X driving older cars, living in homes they bought decades ago, and avoiding luxury branding even when they can afford it. These are not signs of limitation, they are deliberate choices. Every dollar not spent trying to impress others becomes a dollar that can be invested, saved, or kept flexible. Over time, those choices quietly compound. Invisible wealth also protects boundaries. When people do not perceive you as wealthy, they do not expect you to pay for everything, lend money, or solve financial problems that are not yours. This reduces social friction and emotional strain. Gen X watched previous generations stress under the weight of appearances and debt. They learned that looking successful often comes at the cost of being secure. Their lifestyle became a form of financial insulation. Less pressure, less noise, more control. And while it may not look impressive on the surface, it produces something far more valuable: stability. Over decades, this non-performative approach allowed capital to grow quietly in the background. Gen X did not chase the appearance of wealth. They chose the reality of it. That same discipline we just talked about also shaped how Gen X thinks about one of the most misunderstood tools in personal finance: debt. For many people, debt is either something to fear completely or something to use casually. Generation X chose a third path. They do not see debt as inherently bad. They see it as powerful and therefore dangerous if misused. Federal Reserve data shows that Gen X carries significant mortgage balances, yet relatively low levels of consumer debt compared to other generations. That contrast tells you everything about their philosophy. Their rule is simple: debt is acceptable only when it funds an appreciating asset or generates income. A low-interest mortgage on a home or rental property can make sense. High-interest credit card debt for consumption does not. They are willing to borrow hundreds of thousands of dollars for real estate at a reasonable rate, but they will think twice before financing furniture or lifestyle upgrades. This approach became especially clear during the period of historically low interest rates between 2009 and 2021. Many Gen X homeowners refinanced mortgages to lock in lower rates. Some purchased rental properties or expanded existing investments. They understood that borrowing at a low fixed rate to acquire assets with long-term growth potential could accelerate wealth building. At the same time, they aggressively paid down high-interest consumer balances. They did not treat cheap money as an excuse to spend. They treated it as a strategic lever. What makes this powerful is not just the math, it is the restraint. Before the 2008 crisis, many households used home equity as a lifestyle ATM. Gen X largely avoided that behavior. They borrowed when assets were discounted and conditions were favorable. They pulled back when markets were overheated. This cyclical awareness reduced overexposure. It allowed them to use leverage without being consumed by it. Their approach shows that wealth-building debt is not about eliminating borrowing entirely. It is about aligning timing, purpose, and discipline. Debt, in their hands, was not a trap. It was a controlled tool. And like every other part of their strategy, it worked because they refused to let emotion override judgment. And when you combine disciplined debt, diversified income, and emotional control during crises, you arrive at the final piece of the puzzle: consistency. The greatest structural advantage Generation X has is not secret knowledge or perfect timing. It is time paired with steady action. Many members of Gen X have been investing consistently for 25 to 30 years. That length of time changes everything. Vanguard research shows they have one of the highest rates of uninterrupted investment contributions over multi-decade periods. They did not stop when markets crashed. They did not pause when headlines were negative. They kept showing up. The math behind this is simple, but the discipline behind it is rare. When someone invests a fixed amount every month into broad market index funds for decades, the total value of the portfolio eventually dwarfs the amount originally contributed. The growth does not come from genius stock picking. It comes from endurance. It comes from allowing compound growth to work year after year without interruption. Gen X understood something many people intellectually know, but emotionally struggle to accept. Missing even a few prime investing years can dramatically reduce long-term results. Money invested earlier has more time to grow, so they prioritized contributions over upgrades. They delayed lifestyle expansion. They resisted the temptation to stop during downturns because they knew downturns were temporary, but lost time was permanent. This required emotional maturity. It required ignoring noise. It required accepting that wealth building is repetitive and often boring. But over thousands of ordinary monthly decisions, that boredom became power. Their financial position today is not the result of one brilliant move. It is the cumulative effect of decades of consistent behavior. And that reveals an uncomfortable truth. Long-term financial success is rarely about intelligence alone. It is about persistence when excitement fades and fear rises. Consistency is not flashy, but it compounds quietly until it becomes undeniable. And when you zoom out and connect everything we have covered, the real takeaway becomes clear. Generation X did not win because of perfect timing. They won because of repeatable behavior. Their success is not locked to a specific decade or economic cycle. It is built on principles that still apply today. They educated themselves instead of outsourcing understanding. They diversified income instead of depending on a single source. They practiced stealth wealth instead of chasing validation. They used debt strategically instead of emotionally. And most importantly, they stayed consistent when others stopped. They did not experience a smoother economy. They faced recessions, crashes, uncertainty, and volatility just like everyone else. The difference was in their response. When hype was loud, they were skeptical. When fear was everywhere, they were patient. When others performed wealth, they quietly built it. That mindset insulated them from many of the traps that derail financial progress. The lesson is not to copy their exact investments or try to recreate their timing. Markets change, technology evolves, circumstances shift, but behavior scales across generations. Financial outcomes are not random events. They are patterns repeated over years. Change the pattern, and you change the outcome. The uncomfortable truth is that none of this is glamorous. It is slow. It is often boring. It requires delayed gratification. That is exactly why it works. Most people are searching for speed. Very few are willing to commit to consistency. Gen X built resilience first and wealth second. They strengthened the foundation before focusing on growth, and that order made all the difference. So the real question is not whether these principles work. The data suggests they do. The real question is whether you're willing to apply them steadily over the next 20 or 30 years. If you want more deep breakdowns of strategies that actually work in the real world, subscribe to the channel so you do not miss the next video. Because building wealth is not about motivation, it is about understanding the pattern and then having the discipline to follow it.